Let's talk about yields. You have the 10-year, right, which is, right up there close to the 190 mark. You have mortgage interest rates, still at almost historic lows, but they're hitting 2-year highs. And so you talked about the slowdown with the financials, tech. Do you see a slowdown in the real estate space now that yields have trickled up, or do you think that the move isn't really too consequential? Because look, a 0.5% interest rate move higher, if I'm refinancing, pick your number, right? A $500,000 home, $1 million home, $100,000 home, whatever that is, that extra 0.5% isn't really consequential for most people that are able to refi in this environment.
It's a complicated and quasi-long answer.
That's why you're here, Mr. Hodge.
The affordability to buy a house, even with a small uptick in rates, as you mentioned, is still good historically. It's still better than renting, and so that's important. There's large fundamentals driving it in that the millennials are a huge cohort that have to buy houses. I'll probably butcher this a little bit, but I think it's something like every year for the next 4 or 5 years, there's like 5 to 10 million millennials, hitting that 30 to 35 window where they're having kids and buying houses. Plus, I don't think the rates go this way forever. We'll see if they do raise rates. But I think housing is one of those safe havens. You throw it in with gold and you throw it in with utilities. If I was looking before the lakes fell out of the market there in the past 30 minutes today, the REITs and the utility sectors were doing okay. I was buying them towards the end of the day. It's been a crazy week because I've taken that money that was under management. It's now back under my management. And so I'm rotating that money. So it's been a lot of work, especially with the volatility, as you mentioned, that was in the market this week, but getting out of the dumb fucking funds that I was in, right?
I'm not laughing at you, Nick. I'm not laughing at you. I'm laughing with you, man.
that were just tracking the S&P, but were charging me portfolio management fees to do that, right? Like active beta funds, when you could have just bought like the SPX, for example, and paid a much less portfolio management fee. So anyway, I'm unwinding some of that stuff, but pecking into things like utilities. And you mentioned the question was about housing. So I was buying that today. And as you know, I'm in the market to buy more housing, and you own a couple yourself. So no, I think housing is bullish and a safe haven.